Hello everyone, welcome to another session on dollar INR. Something very interesting happening. Okay, but let me progressively go. Let me start with the dollar INR spot chart. Okay, this is a 24-hour chart. So it is offshore plus onshore. We experienced that heavy RBI intervention on Friday, and we saw rupee gaining. We have already covered that in our previous video. And then what we have seen is we have seen a slight sideways movement for the last 2 days. Now it is the Christmas season and most of the traders participants in the West have gone on holidays, so trading volumes are smaller. Consequently, trading volumes in India is also slightly reduced, so you will have less activity and probably less volatility, and that is the reason why you have sideways movement for the last 2 days or so. But this is not where the real excitement is happening. The real excitement is happening on the dollar INR premiums. Okay. Remember, RBI did a swap a few days back. They sold, they first bought 5 billion and sold INR, pumping liquidity into the system, and then that dollar reserve that they accumulated, they used it for some kind of intervention, and that stabilized the rupee. But what has happened is, because of that intervention and probably because of some paying pressure from the importers, the premiums have shot up. Okay, so here what I have calculated on this chart, let me explain it to you. Okay, in this chart what we have is, let me get my marker also at the same time. In this chart I have the premiums calculated for various days. Okay, so this is 1 month, 2 month, 3 month premiums for each of the month, and then you will go till 12 months towards the extreme right. Okay, so each of these days is a curve which shows how the premium has been. Forward premiums annualized, remember it is in terms of percentage and not in paisa. Okay, you can get in paisa just by simply multiplying into the dollar INR spot. Okay, but we are more concerned about the percentage here. So if you look at these three lines, okay, these are 17th November, 24th November and first week of December. Okay, so these are the times when the markets were stable and there was not much of excitement in the forward premiums. Then we had the announcement of the swap, and then the swap happened on 16th, and see how the premiums have shot up. Okay, now if you look at these two lines, the red line is the premium curve as on yesterday. Okay, and it was around 5.3 5.35% for 1 month. Okay, so 5% for 1 month is around 45 to 50 paisa. Today morning, if you look at today's, is this pink line. Okay, today morning 1 month premium was around 54-55 paisa, and it probably closed around 43-44 paisa for 1 month. Can you imagine dollar INR premium 45 to 50 paisa for a month, and that is the reason why the premium shot up so high. Multiple reasons, paying pressure, swap, whatever it is, but what we feel is this high premiums will not remain forever. This is going to cool off very soon. Probably by the end of this month you will see the premiums coming back normally to that 2.5 to 3% range. Okay, so now the real excitement is on the short term premiums, 1 month, 2 month, 3, 4, probably till 5 and 6 as well. Okay, all hovering, see 1 month, 2 month around 4.5 to 5.5%, and then 2, 3, 4, 5 all around, you see 3.5 to 4% premium. Okay, so that is actually very high premiums. Now how do you capitalize on this high premiums? One way is by simply doing a forward, you get high forward premiums, but what we have seen in the recent past is a lot of rupee weakening. Okay, so exporters might not be really forthcoming in doing a simple forward, even though they can encash about 3.5 to 4.5% annualized forward premium. That is one way of doing it. But another very interesting way of doing it is using this chart. I'll just show you. Okay, let me get my marker as well. Marker will be important here. So here what I am trying to do is I am just trying to compare the working capital cost, the packing credit cost, if I take, whether I take in dollar, which is PCFC, packing credit in foreign currency, and if I take packing credit in INR. Okay, so if I take packing credit in foreign currency, I have to pay SOFR, the SOFR rate, the dollar interest rates, plus probably around 1% spread. Good credit rating companies will get spreads around, let's take 65-75 basis points, which is 0.65, 0.75, and most of the MSMEs will get around 1.25, 1.5, medium scale companies getting around 1. Okay, so PCFC cost depending on the spread that you get will be around 4.6, 4.7% per annum. Okay, now if I take the packing credit in INR, okay, I pay around 7.25. Again, for good companies, A rated companies, this will be around 6.6, 6.7. But if I adjust the premium, how do I adjust or take the benefit of premium in EPC? Packing credit taken in INR is simply that I take a 5 crore or INR loan now, and I am going to repay it from my dollar receivables that is going to come after 3 months or 6 months after I have done my exports. I get my foreign currency and I will convert that foreign currency to repay this 5 crore packing credit loan. So for that future conversion, I can take a simple forward. Okay, and when I take a simple forward, I get such high forward premiums. Okay, so if I just reduce that forward premium benefit from my EPC cost, I get a cost around 3.25 to 3.75%, and you compare that with your PCFC cost, there is a straight benefit of close to 1 to 1.5%, 0.9 to 1.5%. Okay, straight benefit interest saving of around 1 to 1.5% if you take packing credit in INR and hedge the repayment of that packing credit for your foreign currency receivable that you are going to get. Okay, so that gives you a lot of saving. Remember, the entire game is for this high forward premium. Okay, if the forward premiums come back to their normal levels around 2.5 to 3.5%, this entire benefit will go off. Okay, it's primarily because the forward premiums, specifically the short term till the medium term forward premiums which are high, that is giving you this benefit. This is typically a arbitrage situation, so you need to look to capitalize this arbitrage. You need to look at this gain of 1 to 1.5% gain that you can get if you take packing credit in INR. So very interesting. Look to save costs. This will also help you in hedging your positions, because obviously because of this rupee weakening, a lot of exporters are not hedging. Obviously they have their mindset that rupee might weaken. Obviously that is future and no one knows what the future holds, but this is short gains. If I am able to reduce my interest cost by about 1.5%, that is substantial saving for my organization. Okay, so that is it from my side. I wish a Merry Christmas to each and every one of you, and a very blessed, happy and prosperous New Year.